As we discussed that financial market consists of two units. One is the money market and the second one is the capital market. We have already covered money market, now we will be covering the capital market, right? So what capital market is? Capital market is a network of all organizations, institutions and instruments which helps in providing medium and long term funds. Fine. A company requires, or any industry requires long term funds for investing in real assets, right, for the capital formation purpose. So for fulfilling these needs for long term funds, capital market helps organizations, institutions and the banks. Capital market basically it satisfies long term needs of the government and industrial sector. Fine. Second, capital market helps in raising and investing long term funds, right, in form of debt and equity. Fine. Third, it says that the instruments which are generally used in capital market are equity shares, preference shares, debentures, bonds and public deposits. So these are the instruments which are used in a capital market for raising long term or the medium term funds by organizations, means the companies, institutions or government, right? There are some features, salient features of a capital market we will be covering there. The first feature says that it links between savers and borrowers. Capital market is actually a link between the savers and borrowers. We discussed in the previous class as well that the savers, they are called the surplus units. They have the surplus fund in their hands, right? And capital market helps these savers to invest their fund in most productive uses, right? So it provides or it bridges that gap, or it provides a link to the savers wherein they can invest their fund, the surplus fund, in the most productive use, and who further puts that fund which is provided by the savers, right? Deficit units, they are called the entrepreneurs or the borrowers. They borrow money from the savers, right? And the money which is borrowed is invested in the most productive uses by this deficit unit, right? Second is it functions through intermediaries. Capital market, it functions through intermediaries or the middlemen, right? There are several intermediaries which are there, which deals in the capital market, and they are the brokers, they are the underwriters and they are the depositors. Now what is the need of these intermediaries? Intermediaries, they are there to make more smoother and efficient. Fine. Intermediaries are there and they help smooth functioning of the capital market. Third one is it works under the SEBI. Now as capital market is it operates freely, but it has to follow certain rules and regulations, the guidelines which are given by the SEBI, Securities Exchange Bank of India. So it operates under the guidelines issued by SEBI, Securities Exchange Board of India. It operates, it regulates the functioning of securities market. Fine. So it basically provides, SEBI provides guidelines for both primary as well as the secondary market. Fourth feature says that it acts as a economic barometer, right? It acts as a economic barometer. As we discussed in the first feature, that it links the surplus unit with the deficit unit. Deficit units, they have ideas but they don't have that much money, right? They have deficient funds, so they arrange it, they get fund from the surplus unit and they put those borrowed fund into more productive uses, right? So how this process is being carried on? Surplus unit, they have funds. Now these funds, with the help of capital market, they are transferred to the borrowers or the deficit units. Deficit units, what do? They put these funds to the best investment opportunities, fine, and they make the fund to be utilized in a most productive and an optimum way, fine. If by doing so, what do? They buy real assets, or they make further investment in some productive or lucrative investment opportunities. And when they buy real assets, when they make value of the money, it leads to the capital formation. If in any country capital formation is more by these deficit units, ultimately it indicates, it depicts that, or it signifies that that particular country or the nation is actually growing and developing. So capital formation ultimately helps in the growth and development of any country, fine. So indirectly you will see the savers, they are helping in the development of the country by providing idle funds, right, or the savings to the deficit units with the help of capital market. These are some of the requisites of a capital market, or you can say what features ideal capital market should have. So it should have these features. The first one is that a capital market is considered to be ideal where a timely finance, it provides timely finance at reasonable cost, fine. Second, where funds are used optimally, where funds are used in an optimum way, hence leads to the capital formation, right. Third point says that such capital market, it operates, or its operations are fair, competitive and transparent, right. Fourth feature says that such capital market, an ideal capital market, provides correct and complete information to its stakeholders, right. The last point says that an ideal capital market helps in, or it helps in accelerating the economic growth of any country. How capital market makes it possible? It, as I told you, that it provides fund, it helps the deficit unit or the entrepreneurs to utilize the borrowed fund in a most productive ways. Difference between capital market and money market. These are the bases on which we will differentiate between the capital market and the money market. The first basis is the instruments, right. What are different instruments which are dealt with in these two types of markets? The first one is the capital market. The different instruments which are dealt with here in this capital market are equity shares, preference shares, debentures, or different types of bonds, right. In money market, the common instruments which are dealt with are the trade bills, treasury bills, certificate of deposit and the commercial papers, fine. Second point says the term duration. Generally in capital market, capital market generally deals with the long and the medium term securities, whereas in the money market, it deals in the short term securities with a maturity period of 1 year or less. Third point says the participants, who are the various participants in capital market or money market. The different different investors who participate in capital market are general public and large institutional investors, right. Whereas in money market, the investors participate are the large institutional investors like banks, mutual fund agencies and the financial institutions. Liquidity. The fourth point is the liquidity. Liquidity means that if securities are convertible into cash or not, that is the liquidity. The existence of stock exchange, in capital market where we have stock exchange, so the presence of the existence of stock exchange makes capital market securities liquid, but to a lower degree, because securities, they are the medium and the long term securities, so the conversion of securities into cash, the time period is quite long, fine. That's why liquidity is lower. Whereas in money market instruments, there is a high degree of liquidity because they are the instruments which are meant for a shorter period of time, fine. It has a very maturity period is very less, means for a year or more less than that, fine. So that's why the liquidity is very high, means they are easily convertible into cash whenever required, fine. The fifth one is the investment outlay. It says that in capital market does not need huge financial investment. Why? Because the value of securities are as low as rupees 10 or less than that, fine. Whereas in money market the instruments are quite expensive, fine. These instruments, they are the trade bill, certificate of deposit, commercial papers, they are quite expensive. That's why the retail investors, they don't participate in money market, right? 6 point says the type of requirement, right? Means what type of requirement or the need is satisfied or fulfilled in money market or the capital market. So in capital market, fixed capital requirement or needs are satisfied, whereas in money market, working capital requirements, working capital needs, they are satisfied or met, right? 7 point says expected return, fine. What is the expected return or the guarantee of return in capital market or in money market? There is a high expected rate of return in capital market due to long-term duration, means the amount is invested for a longer period of time in securities, fine. Therefore there is a chances of capital appreciation, means the amount which you have invested can be appreciated due to the long period of time or investment, fine. And there is a chances that you or the investors can get the dividend as well, fine, because if the company where the investors they have invested, it can perform well, fine, in the long run, hence that company would be able to provide dividend, and the amount which is invested can also be appreciated, fine. In money market there is a low expected rate of return. Why? Because amount is being invested for a shorter period of time, right? 8th point says security and safety, fine. Means how much are securities, they are safe and secured, fine. Investments in investments in capital market, they are quite risky, and there is a risky in terms of rate of return, fine, and the principal amount, the amount which you have invested plus the rate of return, fine. Like if you are making investment, fine, in capital market, fine, if you are buying any securities in the capital market, if there are chances that the amount you have invested can be appreciated and you can get the dividend, right? It totally depends on the market performance or the market share of a particular company, fine. So there is a chance that your investment can be appreciated, you can get the dividend. If market is not performing well, then there are the chances that your investment means a principal amount plus the rate of return can also be, you can also get lower than the value, fine. So the investment is quite risky. In money market, investment is safe. Why investment is safe? Because of the short duration, means your amount is invested for a shorter period of time, plus the financial position or the strong financial position or the soundness of a particular company or the issuer, fine. So these are the various points we have discussed to differentiate between the capital market and the money market. Thank you.